Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is Certified Financial Planner and Registered Investment Advisor, Rob O'Dell. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, we're talking about the basic understanding of tax deductions, exemptions, and credits for individuals to help you with your end-of-the-year appointments with clients and prospects, all from Rob's popular Mind Map seminar series. Well, let's talk about this because, we touched it yesterday. I want to talk, when we talk about deductions, I always go, which ones? My client always says to me, is the deduction worth more? Is the exemption worth more? Or is the tax credit worth more? So first of all, we have to value these three things that are helping to kind of lower our tax bill.
Right. Well, let's talk about deductions, okay? Where are they found? They're found on Schedule A, which is typically the third page of someone's 1040 that they file. First of all, if someone does not have enough deductions, they take the standard deduction. Mm-hmm. But most people I work with, you work with, right. Most people watching, they itemize their deductions. And examples of itemized deductions, the very top thing is medical deductions, and it's based on age. As well as, so people over 65 can get a little bit better benefit than someone under 65. Something very common in Naples, Florida, as well as other parts of the United States, is people are buying into these continued care facilities. Meaning they'll go in, it'll be a condominium, it'll be a full scale as they age and they get less healthy, and they'll have full skills nursing there. And typically they'll pay a lump sum going in, a large lump sum, well into 6 digits. For that portion which is not refundable, so maybe they put down $300,000 and none of it's refundable, they will get a percentage that they can write off on their medical.
As a medical charge. That's just their housing issues.
That's just their housing issues.
Wow.
And then they have a monthly assessment, usually a portion of that. So we definitely keep an eye on that, as well as some long-term care premium can be here. Mm-hmm. Charitable deductions, we're going to spend some time in this show talking on charity, but that's the big deductions, not subject to AMT.
Let me ask you this, because I know that a lot of people are charitably given. They have not only their money that they're adding direct cash gifts, but right. they drive to these places. The government kind of gives you some mileage deduction
and
for that.
And the non-cash gifts, exactly, as well as that they give clothing or furniture. Mm-hmm. They get
now you have to record this and make sure you got a paper trail for that.
Absolutely. Okay. We moved from Chicago down to Naples, Florida this year. We gave a lot of our furniture away to charitable organizations, and we recorded it all. So we'll get some deductions this year. Taxes, real estate taxes, state income taxes, if your state has an income tax, can be deducted here. Professional fees, this is big.
So would you recommend paying my state taxes before the end of the year? So if I knew I had stuff coming up, is there any games to be played there?
Well, it depends. With AMT, alternative minimum tax, may take that away from you. But we put it into our programs to determine, does it make sense? It really depends on what other type of income you have. Mortgage interest, that's a big one that people will deduct. Professional fees. This is something that is often phased out by alternative minimum tax, but sometimes they pay their CPA, their attorney, their financial planner, their money manager, can all be deducted.
So if I'm a registered investment advisor, many of our in the audience are, my client could deduct that fee. They could deduct the CPA's fee for doing their taxes, and any other things that are professional in that regard.
Professional and tax related usually too for the. Let's talk about the significant deductions. So we said long-term care, that's real big, that based on ages. So a 50-year-old can deduct up to $700 for long-term care premium. If he's 71, it's $4,600 they can deduct.
So it ratchets up by age.
Right.
And so whatever my premium is, and I look at the age column, I can pretty much say, this is what I get to take off every year.
Correct. Exactly right.
Wow.
And as you age, it gets higher. And as you age, also, this is something where there's a phase out on the medical expense. So if you make $100,000 and you're under the age of 65, the first 10% or $10,000, you do not get to claim. Anything above that, you do. Same example, it's $7,500 for those over 65.
Okay.
Now let's talk charitable gifts. This is one of my favorite areas to talk about. Example of charitable gifts can be a donor advised fund, it can be outright gift to charity, it can be a charitable remainder trust. And we're going to be breaking this down, but I want to start at a very basic level. If you give to a private family foundation, the maximum income tax deduction, or how much you can take against your adjusted gross income, is 30%. If you give low basis stock, it's 20% of AGI. If you give cash to a public charity or to a donor advised fund, you can deduct up to 50% of your adjusted gross income.
So you give half of what you have on your AGI, whatever that number is at the bottom of your first page of your 1040, half of that could go to these public charities.
It's a cash donation. Now, if you give low basis stock to a public charity, you can only deduct up to 30% of your AGI. So let's say I have $100,000 in AGI, I give $100,000 of stock. I can deduct $30,000. I lose $70,000, right? No, that's not the case. You can carry forward the $70,000 for future years.
Oh, so you could get it, you could amortize it a bit.
Correct.
Okay,
Correct.
so I just want to make sure I'm right on this. So first thing I have to think about as a client and as an advisor that maybe this is new to is I have to think about, is this a private foundation or is this a public charity?
Yeah. Most gifts are public charities, churches,
and is this cash gift or is this low basis stock?
Correct.
Okay.
And if you have low basis stock, it's always better to give low basis stock than cash. So that's something you always want to be aware of.
For more information on end of the year tax planning ideas, just click on the landing page address in the video description. We'll be right back with more from Rob O'Dell.
A solid web presence has never been more important to the success of your business. Introducing Agent Website Creator, provided by CreativeOne. Through Agent Website Creator, you can create your own personalized website and have it up and running easily with zero knowledge of programming. Choose from several designs with easy drag and drop customization. Get proven lead generation offers, professionally written articles, and helpful financial calculators. Plus, the ability to embed videos, integrate your social media, and more. Update your website anytime and show the world within minutes. The best part? It's hosted for free. To learn more about Agent Website Creator, call your CreativeOne sales team at 800-992-2642 or visit us online at creativeone.com.
In this segment, we're talking about tax planning for business owners, all from Rob's popular Mind Map seminar series. And we introduced this in the last couple shows. We're talking about Mind Map. This is kind of a nice technology in itself. This mapping it out.
It really does.
You can put pictures in there.
Is.
The client's 1040 comes up. You can touch all kinds of things. This seems to be the future.
Well, it's a nonlinear way of presenting information. And most people are nonlinears. And it also allows us to brainstorm, problem solve, be able to work with clients who are business owners. In fact, how we stumbled on this was a small business owner was exiting his business. And we asked permission if we could mind map this business exit. And so he and his wife came in, we spent 3 hours with them, and when they walked out, they had clarity and confidence to take action. And so that became what we're known for is our mind mapping and how we work with our clients.
This is a huge acuity perk for demonstrating a client's portfolio, their tax issues,
everything,
what they own. It's really great.
Yeah.
I love it, by the way. Okay, well, let's walk through it. Business owners now, a lot of, remember, America, 70%, I think, is about business owners, are small business owners.
Right.
So this really matters to them.
It really does. Like most advisors who are probably watching this work with small business owners. And as you know something about a business owner, that business is like a baby to them. It's like their child to them. And they intertwine their finances with the business. And the number one challenge as a fee-only financial planner working with a business owner is when they're getting ready to exit, whether they're going to sell it, the next generation is going to come in, or they're just going to shut it down, is they run a lot of expenses through that small business, and now they're going to start incurring those business on a pre-tax basis from personal finance. And so we do elaborate spreadsheets, financial cash flow, network projections, making sure that they're prepared for things that the business used to pay for, they're now going to pay personally.
And just a little side note before we get into the map, I notice you have C Corp up here. I mean, there's a lot of demonstration in tax issues, whether it's C Corp, S Corp, LLC. There's some choices to be made, and if you're thinking about actually constructing or designing a new company, maybe for yourself or your client, you need to look through that, and I have information on that if you
even
want.
state issues too.
Absolutely.
Yeah, so you see that, especially in the state of Florida, businesses are coming down in groves and becoming Florida incorporated through LLCs.
So there must be big perks down there.
Oh, no state income tax. That's a big one there. And the weather isn't bad either. I heard it's snowing in the Midwest now.
Okay.
Let's talk about the C Corporation. If you have clients who have C Corporations, this is almost a no-brainer, if you will. Long-term care insurance premiums are deductible. Now,
so if I have key people.
If you have key people or yourself, you can discriminate here.
Oh.
So if you write a check for long-term care, you get 100% deduction for the C Corp level. Now, unfortunately, they phased out the policies that had 10 pay or single premium deposit. Now they're all life pays, and insurance companies have become wise to us. Section 69, they can deduct up to $50,000 of
79.
79, I'm sorry. Okay. 79, up to $50,000 of insurance premiums are deductible. Something we do now, this may sound self-serving, but for business owners who hire us, we always have the business pay our fees, always. Not investment management, but for their planning fees. So they're going to pay me a project or an hourly fee, it comes from their business, and we make it an executive perk for their key people. Now you just
discriminated here. I think I just heard you say planning fee is one thing.
Yeah.
The AUM, assets under management charge for their investments, is another.
Correct. So it's two separate fees there, but for planning fees, so if someone's going to hire us and they want to come in and do a financial plan for the owner of the business, we can do it, but they can get 100% deduction at the business level. Whereas if they took it to themselves personally, it'd be a Schedule A, subject to a 2% phase out and alternative minimum tax.
Now, I've been looking, even for myself, on Section 79 for my consulting. Is this time to upgrade my computers? Is it time to do some things? This is the time when you look at this kind of property where you can write this through Section 79. So you need to be aware and bring this. Many of our business owners, I don't think, understand all the things. And online, it gives you the complete list of everything on Section 79 that you can do.
Very good point. And finally, the 800-pound gorilla in the room, retirement plans. This is something where they can put a lot of money into. There's two flavors, and in a future show, we'll talk more on the retirement plans. But the two big broad categories are defined benefit plan, which allows them to put a large amounts of cash pre-tax away. This is for someone maybe in their late 50s, and they're thinking about, I got to catch up and I'm making great cash flow. We'll establish this. Now, you cannot discriminate in retirement plans, ERISA plans. So it has to be you need to look at the situation, how many employees there are, and ages and incomes there.
Now I have to say, Rob, though, most of the plans I've seen over the last 5 years are almost all of them are defined contribution plans. The employer doesn't want to be able to be obligated to some serious payments later on in a defined benefit plan.
Yeah, usually the defined benefit plan, you're looking for an owner who might just be husband and wife, or they might have 4 or 5 family members or people who are like family to them that are making good income.
Sure.
But you're right. Most employers are switching to defined contribution plans, a 401k, profit sharing. That's defined contribution.
Okay, let me ask you a question. Have you found lately, in the last couple of years, are employers still doing matches? And if they are, what are they going to? What's our cap right now?
They go between 3 and 4%, and that's for safe harbor reasons. So you have the owner who's making large income, he will or she will put 3 to 4% in there so that they can max out their benefit.
And have you seen predominantly people that are going to open up, if we have a client that wants to open up a 401k before the end of the year, are they going to, you see people, are they matching or are they pulling back because of the economy maybe?
I see matching going on. At least for the safe harbor. At least for the safe harbor, absolutely. That's fair. And we also, that they look at, you run the numbers, and even that 3-4% match or employer-funded contribution is actually, the owner still turns out in the better for doing that, just from a pure tax perspective.
Well, for more information on all that we're talking about for business owners, just click on the landing page address in the video description. And for more information on our shows, seminars, and workshops, don't forget to just follow us out on our social media and visit us out on our website. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.